Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I'm going to do something slightly different, going to take a look at a sector more so than an individual stock. I am going to do it through the eyes of Realty Income, so big focus on Realty Income, but some of these things will apply to REITs in general, and price action on REITs has been very negative, so it makes me think maybe there's some value here, but I really want to talk about the risks that are going on with REITs, triple net lease REITs in general, and then other REITs that a lot of this stuff will apply to. Note, I do own, in my Dividend Aristocrats portfolio, a very small holding as a portfolio of S&P 500 Dividend Aristocrats. And also note, this is not investment advice. Please do your own due diligence before making any investment decisions. After all, do you want to trust the guy that is wearing an Otter Space t-shirt? I'm going to have you take a look at it. It's awesome. Otter, Otter Space. All right, let's get started. Price action has been negative, which means dividend yield is becoming more attractive, and REITs are very much a dividend yield focused investment. They pay out 90% of their net income by law. And again, that's net income, not cash flow. So that's a difference. They can certainly cut their dividend when needed to shore up their finances. So dividend yield here that used to be in that 3 to 5% range for the majority of the last decade is now hitting 6%, outside of the 2020 dip that this stock took, and it's basically down to the 2020 lows, which is very interesting. And what is driving that? It all comes back to yields. The risk-free rate has gone from basically 1% to 4.5%. So now as you look at this investment that has really been buoyed by low bond yields and started to become a very attractive fixed income alternative, now that those bond yields are higher, this becomes less attractive. REITs in general become less attractive. When you can get 5% at your bank, when you can get a 5.5% yield on a 2-year treasury, a 4.5% yield on a 10-year treasury, you need more from REITs in order for them to be an attractive investment because of the risk you're taking in investing in a stock. The risk-free rate has to have some sort of risk premium on it to get to a stock, so REITs are less attractive. And in fact, many REITs have kind of existed in this golden zone of falling rates. Yeah, there's been some periods of ups during this period, but in general, rates are down from historical rates in that 5 to 10% in the 80s and 90s, basically down to zero by 2020. 2019 range, and now they're going back up to 4.5, and it's a golden zone because if you think about something like these guys were IPO in the 90s, somewhere in the 1994 range, when rates were close to 7.5%. And they've basically gone down for the entirety of their existence. And that means they can get cheap funding, property values rise, and they become a more attractive alternative to fixed income investments that are forever dropping. And now that that's ending, these things are also ending a bit. And yes, REITs can exist in a high interest rate environment. Cap rates will adjust due to the higher costs of capital that make the cap rates required, that make the cap rates go higher. But it can take a few months, a year for that adjustment to happen. And the property values that these companies own may be impacted. Now, they're not going to be impacted on their balance sheet on paper. They're not going to be written down immediately or ever sometimes, depending on what happens to the properties. They generally keep them at cost on the balance sheet. But the perceived value of these properties will go down and be reflected quickly in the public market. So let's look at cap rates, cost of capital, and how REITs fund deals. So a cap rate, if you don't know, is basically the net operating income of a property or a group of properties divided by the cost of the property. So if you want to buy something that generates a 5.8% cap rate, that means a $100 million property needs to generate 5.8 million in net operating income being the rent minus costs in general for a property. So they fund these deals if they want to buy a $100 million property 3 ways. They issue shares in the form of equity. So here's $1 billion worth of shares that are going to dilute the holder of the stock, but we're going to buy a property that's going to be accretive to earnings, that's going to have a higher cap rate than the cost of those shares. They can issue debt, so basically use debt, borrow money in order to fund these acquisitions, or they can issue their cash flow. And obviously cash flow is cheapest because it doesn't cost you any money. It's generated by your business. So there's a couple of ways to value equity. There's the CAPM model. There's a yield methodology. There's an AFFO yield basis. I just took the average of those 3. I'm not going to go into detail there. And then the cost of debt is how much you would pay to issue debt. So in 2021, cost of debt was cheap. Equity was pretty cheap because the stock was at a high price, so issuing more shares dilutes you less, costs you less. So in general, you got a 5.4% cost of equity, a 3.5% cost of debt. If you're funding your investment with 60% equity, 30% debt, and 10% cash flow, your weighted average cost of capital is 4.3%. Generally, if you're a REIT, you're going to want a deal spread, some sort of improvement on the cost of capital in order for you to make money. So in this case, we're putting 150 basis points in there. So your required cap rate is 5.8%. If you think about it, if your cost of capital, if it's going to cost you 4.3% to buy something, you want to buy something for more than 4.3%. Usually the spread is 100 to 150 basis points. Just for fun, I'm using 150 basis points here, which means that if you're buying this property in 2021, you might require a cap rate of 5.8%. So you're happy to buy this $5.8 million NOI property for $100 million. No problem. You go to 2023, the cost of capital is going up. Your treasury rate is higher. Your dividend yield is higher because the stock is worth less. Your cost of debt is higher because the 10-year treasury is a lot higher. So your cost of equity goes from 5.4% to 7.7%. Your debt goes from 3.5 to 5.5. These are just examples to kind of illustrate what this means. You use the same funding mechanism. Suddenly your weighted average cost of capital goes from 4.3% to 6.3%, which means that you require a new cap rate of 7.8% in 2023, whereas you were perfectly happy to get a 5.8% cap rate in 2021. If you are valuing this property based on the net operating income it brings, and now you require a higher cap rate, that means the property value goes down. And the public markets quickly react to these perceived changes in valuation, even if they're not ever going to be reflected on the balance sheet. That means that, hey, if this property that generates the same exact income and has the same exact qualities that you were looking for in 2021, that you were happy to pay for $100 million for that property in 2021, now you would basically pay $74 million for that property because you require a higher cap rate because the cost to acquire that property is a lot higher in 2023. So that is basically a change of 26% in just 2 years because your cost of capital moved up 200 basis points. Now, potentially, you're going to have a better net operating income on something you bought in 2021. So even if your cap rate's going higher, maybe the property is not down 26%, maybe it's only down 22%. But now, even if you adjust for potential rent increases, doesn't have a huge impact. On top of that, even if you do that, there's always the fear that exists that rates may go up even higher, which means your weighted average cost of capital is going to go higher, which means your required cap rate is going to go higher, which further impacts the value of your property and further potentially impacts the value of your stock. So the REITs were kind of in the doldrums, thinking that the Fed was going to say, hey, we're going to pause interest rate raises and maybe lower them. But in the last Fed meeting, they basically said, well, maybe there'll be a bit more in terms of raising rates, and maybe the rates will stay higher for an extended period of time, which impacts their property values. And on top of that, it impacts their ability to refinance their debt at lower rates, because REITs often refinance things in infinity. Basically, they take on debt with the assumption that they're not really going to pay it off ever because most of their cash flow goes towards dividends. They're going to keep refinancing and kind of pushing it down the hill, paying the interest, slowly paying it down. They're going to pay some of it down, but they're not going to pay a ton of it down because, like I said, most of the cash flow goes toward dividends. For example, as an example, generated about $2.7 billion in operating cash flow in the last 12 months, and they paid about $2 billion in dividends. So maybe they have a $700 million in operating cash flow towards acquisitions or paying down debt. So there's some, right? There's a little window of freedom that means that the business can exist while still paying dividends, which is what you want to see. You don't want your dividend to take up 100% of the cash flow. That's not a good thing. It probably leads to a future dividend cut. But that money's not going to pay out all of this debt. So they have to refinance it at a higher level, especially if interest rates stay longer for an extended period of time. For example, in 2024, they have just shy of $2 billion worth of debt due, but let's imagine it's $2 billion for the sake of easy math. Their current yield on that debt might be 3.5%, which means it's about $70 million in annual interest that they pay on that debt. If they refinance it, they maybe have to pay 5.5%, which is an additional $40 million in interest that they would have to pay on that debt based on that refinance. Now you think about 25, there's another million that's going to be refinanced. at a higher rate, which means a higher interest payment, which means a lower cash flow at the end of the day, because all of this floats down to their bottom line. Now, companies like O, which have a strong balance sheet and have a strong debt rating, they can probably refinance at low rates. I mean, they're still going to be higher than they have now, but it's not going to be world ending. However, companies that have a low debt rating might have to refinance at very high rates, and that is going to impact their free cash flow, that is going to impact their ability to grow, and may lead to dividend cuts. You've already seen some REITs cut their dividends because they see what's coming. They see that some of their debt, if it's not staggered as well as this one, is going to come due soon. They're going to have to refinance at very high rates. They're going to need that additional cash flow that the dividend is already taking up, and they may have to lower their dividend. Now, I'm not worried about O's dividend because they have pretty good dividend coverage. You can kind of see that their dividend coverage has only gotten better. The FFO, adjusted funds from operations, are about $4, whereas the dividend per share is about 305. But you do have to wonder what's going to happen to other REITs that have a bit of a worse debt profile, a bit worse, dividend coverage. If your dividends are close to your AFFO and you know that your debt's going to be refinanced at higher rates, are going to stay that way for an extended period of time, that could be a problem, right? If you look at something like if they start feeling pressure on the debt side, if there's a downturn that affects occupancy rates, or if they just need a cheaper source of funding deals, they could cut the dividend to make that happen, right? At the end of the day, the cheapest way to fund deals, now that cost of capital are very high, would be your own cash flow. And if they're only generating $700 million in excess cash flow, that's not a lot when you consider is probably going to acquire something like $5 to $10 billion worth of assets in the coming year because of how big they've gotten. Now, the good thing about O is they are very consistent. Their occupancy rates have been very strong even during economic turmoil. So you may see it as a safe haven that is now priced more appropriately to the values that are currently reflected in the public market. So yeah, their properties are worth less, but they're still 99% occupied. They're still collecting revenue, rent, net operating income, maybe at lower cap rates, which may put some pressure on AFFO once they have to refinance that debt that they used to buy those properties that were potentially elevated. But they're still probably in a good spot if you feel like their portfolio is high quality, right? The thing about O is that they've grown especially large in recent years, potentially buying at elevated values. They've basically doubled in size since 2020. They were, they had $15 billion worth of assets in 2017, maybe about 18 to 20 billion by 2020, and now they're in the 43 billion range, which makes it harder to grow. Yes, they potentially bought at elevated values, but they did use a low cost of capital to do so. However, once that debt gets refinanced, that might put some pressure on AFFO because retail does not have super high recapture rates, nor do they have super high escalators in their contracts. And I'll talk about that soon. And if you look at their portfolio, their clients, do you think this portfolio is as resilient in 2023 if there is a recession as it was in 2008? They do have grocery stores, convenience stores, dollar stores, home improvement. Those are usually pretty good in a recession, but retail is weaker than it was in 2008 for sure. For example, CVS Pharmacy, which is 1.5% of their rent, basically is closing 900 stores. Who knows how many of those are part of O's portfolio, and what are they going to do to fill those stores? Do you think companies that are struggling financially, like Dollar General, Walgreens, that are seeing pressure on their margins, will they close some stores? Is their expansion into gaming fruitful, or is it just something they have to do because they can't find any additional growth opportunities in the retail sector now that they're so big? So once you get scaled up, it gets harder and harder to grow. If you think about having a portfolio that is on book $43 billion, maybe higher, maybe lower, depending on what's happening in property valuations, you have to acquire $4 to $5 to $6 billion worth of properties every year just to grow 10%. That's as big as some of the smaller triple net lease retail REITs. And that applies to a lot of REITs. Once you get big, it gets harder and harder to grow. You have to acquire more and more stuff. And that's difficult, especially if you move outside of what you know, right? This is a retail REIT, but now they're moving into gaming. Now they're moving into vertical farming. Now they're moving into Europe. Is that a good thing or is it not? So we talked about cash flow, recapture rates, occupancy rates. So their cash flow visibility is very good. You know where leases are, where they expire. The problem is they have relatively low-ish capture rates, recapture rates, which means that when a lease expires, they negotiate an increase, and those increases are in that 2 to 5% neighborhood. That's normal for retail. And that's fine, but you acquired a ton of properties in 2021, 22 that probably have cap rates that are, in that 6 to 6.9% range, maybe even lower on the gaming side. You're not going to, you have 2% escalators in there. 70% of their leases do not have CPI based escalators, which is a bit of a problem. So inflation might catch up to them if they only have 2% increases and 3% recapture rates. And on top of that, you've got the added cost of debt being refinanced at higher rates, debt that you used to acquire those properties at low capital rates that may eventually be a push on their AFFO if rates stay elevated for an extended period of time. And that's a bit of a problem because if you think about smaller REITs, they can acquire properties now potentially at 8 to 9% cap rates. So they're spending less money on something that O spent more money on 2 to 3 years ago. And maybe they have more opportunities to grow via acquisition than O, which even if they acquire things at cap rates that are more commensurate with the current weighted average cost of capital, it's going to be less of their overall portfolio, right? It's going to be 8 to 10% of their portfolio. And on top of that, they have to move into other areas now because maybe retail isn't what it used to be, or they can't acquire as much retail as they can at cap rates that they find attractive. So they're moving into casinos, vertical farming, Europe. Is that a good thing? Is it a bad thing? Can they do a good job in areas that they don't have a history in, right? This is a retail REIT. They've excelled in retail. Now they're moving into gaming. The cap rates they got from the casinos are in that 5 to 6% range. Not very amazing when you consider their high cost of capital now. Some people think maybe that's an overpay, but maybe they're doing it because, hey, these are marquee marquee establishments rather. Maybe we can sell them at a higher price. Maybe we can dispose them at a higher price. And Realty Income, like any other REIT, does dispose of certain assets from time to time. But if you think about their dispositions, are they going to be able to dispose things at an actual gain versus what they bought them in the last couple of years? Now that rates are higher, now that people are going to be paying less for their properties. On top of that, are their acquisitions going to be as attractive now as they need to be? Because a lot of times when cap rates have to go up to do higher rates, people are less willing to sell at what they perceive to be a low value. If you bought something for $100 million 3 years ago and now somebody is offering you $75 million, you're going to be like, no, that's not what it's worth, but it's worth what people are willing to pay for it, right? And if it's worth less, it's worth less. You may think that rates are going to go down, which will increase its value based on the income you're getting and the weighted average cost of capital, and maybe you can wait it out. But eventually, if rates stay elevated, you'll have to sell at the new valuation, which is what Realty Income wants because they want to generate sales. But is there going to be a little bit of a lag time that is going to, be longer than usual when reflecting these new cap rates that they need to grow their business, to grow their AFFO? That's really the question. So interesting area to be in. REITs are certainly struggling right now. You are looking at every REIT that is basically falling simply for the fact that now their cost of capital is a lot higher. There's more risk in terms of their future cash flows because a lot of them have a lot of debt on their books, and it's fine because it's supported by equity. But if they have to refinance it at much higher rates, depending on what those rates are, it's going to put pressure on their cash flows, which may mean that their AFFO starts shrinking. And that puts pressure on their dividend, which means dividend cuts may be coming. I don't think that's the case for Realty Income. They're a well-managed company. They've done well. But it's certainly the case for other REITs, and it's already happened in certain situations. I know BDN, a smaller REIT, cut their dividend, and there's probably a bunch of others. I'm looking at a variety of REITs as interesting investments. Realty Income is one of them. ARE is another. Alexandria Real Estate, ESS, ADC, probably forgetting a couple of others. But if you look at their valuations now, you may just say, wow, this AFFO at 12.3x or whatever it is, it's as low as it's been since 2008. Well, that's because the alternative, the risk-free rates prior to the 2008 recession, when this was trading at about 13x or so, are kind of where they were then. So maybe this is the right multiple for a REIT to be in that 12 to 13x range. So if you're thinking, well, if rates stay elevated, that doesn't matter. This is going to go back to that mean of 17.5x, and there's a lot of valuation to be gained there from price appreciation. I don't know if that's the case. If REITs stay elevated, there's going to be at least a couple of years of pressure on all REITs as they refinance their debt to higher rates. That puts pressure on their cash flows. They kind of have to get used to the fact that the properties they bought a couple of years ago, when they get refinanced, are maybe a bit underweight in terms of the AFO gain they're getting on those in relation to the debt that is now being refinanced at much higher rates. The properties they acquire have to come at higher cap rates, which is why if you look at the latest acquisition of that, what the Bellagio or whatever it was a 5.1% cap rate or 5.9%. I don't remember what it was. That's not great when your cost of capital is probably in that 6 to 7% range. Now, there was some underlying stuff that came with a 3.5% fixed mortgage. There was some preferred shares, so maybe the equity yield was closer to 7%, whatever. But you do have to look at their acquisitions more closely and hope that their cap rates are no longer 6.9%. Now they're 7.9, 8.9, because their average cost of capital is higher. And the cost of capital illustration I had here, that's not applicable to everything. Some use more debt, some use more cash flow, some use more equity. Some costs are higher and lower. This is just kind of an example based on historical costs. And again, the valuation thing I showed is also not just how you value properties. It's not just on the basis of their cash flow, but it's just a way to look at it. It's just a way to illustrate why prices are down. It's not just the fact that interest rates are up, but it's how those interest rates impact the properties. The fact that their debt is going to have to be refinanced at higher rates, and that adds additional risks. A lot of REITs are heavy on the debt, maybe a bit too heavy. And if they start to refinance at much higher rates, their debt ratios or debt ratings get downgraded. That could be kind of a snowball of bad effects that lead to the business really grinding to a halt. If the stock falls too much, then their cost of equity goes higher and higher, right? Each time the stock drops a percent, their cost of equity is higher. So if they issue new shares to acquire new buildings, new properties, they have to make sure that the cap rate is really good. If you kind of think about just from a yield perspective, Realty Income is yielding 6% and maybe growing their dividend at 2%. Each time they issue a new share, they issue $1 million of shares. That is at minimum a 6% cost to them plus whatever growth they have at minimum, right? Because they're going to have to pay a 6% dividend on those shares that they issued. So they better be acquiring a property that's at least 7 to 8% in yield in net operating income and cap rate to offset those costs. And if the stock price keeps dropping more and more and more, each equity share issued is more and more expensive. And that's kind of the problem with REITs, is that when they go up, their cost of capital is cheaper because they can issue shares at a cheap rate. But when they start falling, their cost of capital is a lot higher. And that can compound on itself if it falls more and more and more and more. And suddenly maybe it's an 8% yield, a 10% yield, and that's a problem, right? That makes it very difficult to get properties at accretive rates. And that's not the case for Realty Income yet, but it could be the case for a lot of these REITs that have fallen a ton, and suddenly their AFFO yield is 8 to 10%, their dividend yield is 8 to 10%. All that means is that, listen, you got to get ahead of your debt. You got to probably cut your dividend. You probably have to figure out a way to dispose some properties, and maybe at bad valuations, right? That is the reality for some of these REITs. If you're looking at small REITs that have a ton of debt, think about what it means when they have to refinance that debt. Think about what it means if they run into some operating troubles. If there's a recession, sure, you may think, well, rates might fall. Sure, but rates will probably fall if there is a recession. And if there is a recession, those are going to negatively impact REITs as well. Occupancy rates are going to go down. AFFO is going to fall. Dividends may be cut. Stock prices may fall further, making it harder to acquire properties and grow AFFO. And then debt may be harder to come by because banks aren't willing to lend to certain companies. Now, Realty Income is in a good spot because they're one of the bigger ones. They're a known entity. They're a known name. They have a really good debt rating. Their debt is well spaced out. They can probably cover it well with cash flows. They haven't had any issues with occupancy rates. So they're in a good spot and they're getting interesting, but there's still a lot of risk with REITs and Realty Income simply because their cost of capital is going up and there's no end point at this point, right? If rates jump another 50 basis points, stocks will drop further because their cost of capital has gone up, their properties are worth less, and they have to acquire at higher cap rates. If it goes up another 50 basis points, even further, right? Now, the opposite obviously true. If rates start dropping and the economy is still relatively strong and occupancy rates stay high, yeah, valuations could go up. It's all dependent on those rates. And anytime you have a model or an industry that's very dependent on something that's external, it's tough to really make a case for it one way or the other. You kind of have to look at it from, well, when rates were this high, what was the valuation? And if the valuation was in that 13x range, well, maybe this is priced appropriately. So from here, you're going to get, your dividend, which is 6%, and then maybe AFFO growth, which is 2 to 4%, depending on that. And maybe it's pushed further down because of the debt issues, because of the fact that you have some properties that are maybe a bit underwater, maybe you have some closures, maybe occupancy pressure, et cetera. So yeah, you're looking at 6 to 10% returns. Is that all that enticing? Meh. If you're looking for income, is it a good income play? I guess, but I mean, you can also get 5% from a 2-year bond, depending on how long you're looking out. 10 years at 4.5%. So is 6% enough? Does it need to be 6.5%? Does it need to be 7? So as I look at and really kind of getting into it, I'm thinking maybe I need like a $45 price range. That's kind of where I would be like, well, this is interesting. Same with some of these other REITs I mentioned. ARE, maybe I need it at $85 to $90. Then it'll get interesting because there's a lot of risks inherent in this. And I'm sounding negative here, and that's because I just want to be realistic. I know there's a lot of videos that are like, wow, the AFO multiple is 12x. It hasn't been at 12 since 2008. Well, the rates haven't been as high as they are since 2008. So maybe this is the right multiple for it, right? Maybe the properties are valued less. There's a lot of videos that say this thing is trading 30% below net asset value. Yeah, but what is net asset value? It doesn't reflect the true street value of these properties at these new rates, at this new weighted average cost of capital. So for me, I need a better risk premium on something like this. And I own so I think I said that at the beginning, but I own it in my Dividend Aristocrats portfolio. I add to it, $200 a paycheck to all 50 stocks or however many there are there. So it's not a lot, but if drops to a 6.5% yield to a 7% yield, would I put, a bunch of money in there? Probably, because I think this is an overall good company that I think has some risks in it. So I need to be rewarded more than just 6% on a dividend basis versus the risk-free rate. And I think there's some risk on retail in general. Not a huge fan of retail. Is it as recession-proof as it was in 2008? I don't know. Probably not, honestly. Dollar General is struggling on their stock price. Walgreens is struggling. CVS is closing stores. AMC Theaters is not doing great. A lot of their companies are fine if we go back to this, but they're not like amazing. I'm not looking at, where was this list? I'm not looking at, did I skip it? Yeah, I'm not looking at, Lifetime Fitness and CVS Pharmacy and 7-Eleven and being like, holy crap, I want to own this stuff. It's not bad by any means, but it's not like if Walgreens shut down all their locations and said we're going out of business, would it be like, oh my God, that is amazing. I could not believe that happened. No, Walgreens sucks. Their stores are a mess. That's the problem with triple net leases. The company renting from you pays for maintenance, but are they taking great care of these locations? I've been to a bunch of CVS locations that look like a disaster zone, right? What are they going to do with that when CVS moves out? They probably have to spend money to refurbish it, to make it look better, to rent it out again. That's a cost to them. That's an impact to operating cash flow. And that is a bit of a problem when they have higher debt that is already going to hit operating cash flow, et cetera, et cetera, et cetera, et cetera. So keep that in mind as you invest. That's really all I have to say. Again, not investment advice. Please do your own due diligence before making any investment decisions. I hope this video was helpful. It gave you another perspective on REITs and what's going on besides everything's amazing. It's not really amazing, but there are opportunities here if you can stomach further drops. If you invest in, marquee names like Realty Income, I think they're going to be just fine, but I don't expect this to be like, wow, this is going to be a 30% return right away. Sure, if interest rates drop and they do well in terms of maintaining occupancy rates during a recession, then yeah, this price point is fantastic. But for me, if interest rates are going to be elevated for long, I'm just as happy keeping my money in my cash account earning 5% until I can get 6.5, 7% on something like this. That'll be interesting. I want that 150, 200 basis point risk premium from a risk-free rate. And that's with most REITs, but I am looking at REITs closely, but I just wanted to see, well, what do I think about them? So I made this spreadsheet. Not investment advice. Please do your own due diligence before making any investment decisions. If you enjoyed this video, let me know what you think, and subscribe to the channel if you want to see more. Generally, I do more stock investment analysis specific to a company with a spreadsheet that has financials, etc. This is more of an overall view. It doesn't really analyze anything, but hope you enjoyed it. Hope you had fun. Have a good day.